Welcome to the Spirited Agent Podcast. We're pouring wisdom and sipping success one episode at a time. The Spirited Agent was created to empower agents to navigate the ever-evolving world of insurance and grow their business. Grab your glass and let's get inspired to protect your clients from the unknown. Here's your hosts, Millennium Brokerage Group Legacy Planning Executives, Jason Combs and Matt Zelenin.
Hey everyone, and welcome back to the Spirited Agent Podcast. Today we have Justin Sykes here with us. Thanks for coming, Justin.
Thanks for having me.
Justin is a regional vice president here at Millennium Brokerage Group. He's out in the field working with agents and agencies, meeting with them on a daily basis. So he's got a really good grasp on, what Millennium's seeing out there today. And so with that, I think we'd like to get into what we're drinking today.
Yeah, so this week we got a bourbon. This is a David Nicholson 1843. It's a wheated bourbon, and it's actually the original recipe that's made up of Pappy Van Winkle. Now, Pappy actually purchased this recipe from David Nicholson, and it's really smooth.
Yeah, very smooth.
And something you need to check out. It's a value brand, so if you're looking for something that's pretty smooth and easy, you may want to check this one out.
For the price, I mean, we were kind of shocked. It was $30. So I feel like for $30, it's a nice, smooth sipper.
Yeah, that's a good pour for $30.
Yeah, absolutely.
It is smooth. It's pretty sweet. I like a sweet bourbon, which I guess is the wheated, right?
That's why we got it for you.
Yeah, thank you.
So, Justin, just kind of give us, on a daily basis, what are some of the things you do to support the agents in the marketplace?
A lot of my agents, as you know, are property and casualty agencies and financial advisors.
Sure.
Everyone I work with is independent. They're not tied to one insurance company. They own and are running their own businesses. So they've got the flexibility and kind of the latitude to do what's right for their client. But a lot of times, they don't always know what that is.
Sure.
They look at me kind of as a specialist and to kind of help direct them on what's important, what's making an impact in the marketplace. They look to me for help with process. A lot of them look to me for help with their staff and getting their staff kind of set up with a process to understand how Millennium works, how the different companies work, and where they really should be spending their time focusing to be more effective in their business on the financial services side.
What are some of the things that you're seeing right now that's driving business, driving revenue for some of the agents that you're working with?
My main focuses are life insurance, long-term care, disability, and annuities. Those are the four things that I focus on. And of course, from a day-to-day standpoint, we do a lot in the life insurance business, right?
Sure.
Life insurance market. So more specifically, a lot of times people, especially that aren't doing this all day, every day, that's maybe not their main expertise or area of focus, they think of life insurance as something that their employer offers, or they think of life insurance as a term life policy that they're buying for a certain amount of time.
Right.
As a protection vehicle, protecting their family, right? Matt, you've got a young son,
young kids. So
you need to make sure that if something happens to you or your wife, that your son's protected, financially protected. And that is, obviously life insurance or insurance in general is a protection. It's a protection solution. But what people don't oftentimes realize is all the different things that life insurance can do. And so I'm showing them other things that life insurance can do. The other thing that, that I try to try to help them with is to focus on where to spend their time. At Millennium, we represent about 30 different insurance companies.
Right.
And so if you're looking for, just going back to that term life example, you're looking for term life,
right? And
you plug in the information of the client and, what you're looking for in terms of a benefit, maybe a 30-year term for $1 million. You're going to get 30 different outputs, or maybe even more than 30, because some carriers have multiple products. If you don't know what to look for or where to focus your time, which is going to be the best solution for your client, what's the thing that an inexperienced person is going to look at?
Sure.
They're going to look at price.
Yep.
And so they're going to go to the top of that list because it filters by, lowest to highest price. And they're going to select that one.
Right.
And a lot of times I had a conversation last week that the agent calls me and he says, hey, carrier A or carrier B,
right,
the best, which one's going to be the best?
Sure.
And really what he was telling me is carrier A is the cheapest.
Yeah.
Is it okay to sell that one?
Right. Yeah.
That's what he was really asking. I actually directed him towards carrier B because it wasn't a big difference in price, but I knew that the process was more likely to go, the underwriting process and the implementation process was more likely to go in the client's favor and be smoother.
Sure.
And a lot of that is what do I know, right? I mean, as the one that they're looking to, as the experienced one, what processes do I know? So how can I set my client, which is my advisor, how can I set their expectations so that they can then set their clients' expectations on what to expect.
Yeah, life insurance is a little bit of a tip of the iceberg kind of scenario. It's like everybody sees what's above water, and that's just, price. If you die, you get benefit. But then in our industry, we're everything below the water, and that's a lot to know.
Yeah, so you talked a lot about the process, right? So, there's been a lot of change in the marketplace. Technology's become more prevalent. Are you seeing that the process is getting easier for people? Or do you think it's still getting harder?
Number one, everything has moved towards an electronic application.
Okay.
Which I would say is a lot easier for the agent or the advisor. Yeah. Even still, the insurance company, the underwriter's got to get the information in some way. So the question is, how are they getting that information on the risk or the health of the person applying? So you've got to set that expectation up front on what's going to happen. Advisors, agents are trying to get the most, the easiest, most direct way to the end. That way would be a drop ticket. Well, that just means that your client's now got to go through another step in that process, either for an electronic interview, through a telephone interview. As long as they know what to expect, that's fine.
Yeah. So it's getting easier for the agent, but they're putting more off to the customer. And so the challenge with putting more off to the customer is getting the customer to actually do what they're supposed to do.
To follow up on it, exactly.
To do what they're supposed to do. Yep. So that brings it back to the agent, getting a little easier, but yet having to do a better job of kind of setting the expectations with the customer. What are some of the best practices that you've seen working with agents to kind of get them up to speed on some of that, making sure that they know all the details with this specific carrier type scenario?
It's easier to go with what you know. If these advisors focus in on a couple of carriers versus 10 or 20 or even 30 carriers, if you write 10 policies a year and you're writing with 8 different companies, you don't know what you're doing.
Yeah.
Because everybody, and it's just as soon as you learn how to write one company, they might change it if you're not doing enough business with them. So you've got to understand who you're writing with, what their process looks like, so you can explain it to your client.
Right.
And then the other thing is just keeping in contact with that client and letting them know, because as we know, there are times where we get policies approved in a couple of days.
Sure.
Which is great. And that's the goal, right?
Right.
But if you're going and telling your customer, hey, we'll get this done, we'll get it done quickly, it'll take a couple of days, it'll be really easy.
Right.
They believe you, and that's what they expect. Well, as soon as it takes 2 weeks or 3 weeks.
Yeah, they're frustrated.
Which is, I would even say 2 or 3 weeks is a success. The average time in the industry is what, 45
days. Yeah.
So, I always try to tell people it's going to take, 4 to 6 weeks.
Right.
Yep.
It could be done in a couple of days, but we need to expect that it's going to take 4 to 6 weeks to get a process done. But the good news about it is, especially for the advisors, once it's done, it's done. You're not having to redo it every year. Once that policy is in place, there's not a whole lot to do on the back end.
So the underwriting piece is a big part of this, right?
Absolutely.
So, you talk about it could take 45 days. So you could take a couple months. It's a big piece. And that's a piece, in my opinion, that a lot of customers don't really truly value that piece of it. But there is a lot of value that comes with that underwriting once you're insured, especially if you get a good offer, like a preferred rate or whatever. So what are some of the things, some of the programs that are out there in the marketplace that helps people capitalize on some of those underwriting decisions that are made?
There's a lot of things out there to help you enhance your life insurance portfolio
right
after the fact, to where you don't have to go through it again.
Sure.
So the first thing I'll say is, a lot of times you'll see a split ticket option. You'll see somebody that wants some permanent insurance, which I think is a great design, a little bit of permanent insurance and a lot of term insurance.
Right.
Especially like in your example, Matt, you got a young son, you want to have a lot of coverage, but you don't necessarily need that forever.
Right.
You just want to make sure you're getting him through, life. Right.
So you're kind of stacking that to taper off.
Yeah. So the first piece of advice I always try to tell people is focus on one carrier for both policies. If it makes sense, unless it just absolutely doesn't make sense to do that.
Sure.
But if you've got a carrier that's offering a good product portfolio in the permanent space as well as a competitive term product, then you need to focus on that.
Sure.
Right? Conversion's another one. The key is, how do you, rather than going through the process multiple times,
right?
How do you streamline that process and just knock it all out at once?
So you had mentioned, 30 different products, you wear many hats, you help people in a lot of different, how do you keep up with all this stuff?
It's a struggle.
Yeah.
But I do the same thing. We've got all these carriers, and I focus in on the ones where I've got relationships with an internal staff. I've got relationships with the whole, their external wholesaler, and I'm in communication with them. And it really is. It's not something that, at least for me, it's not something that I can study. It's something that I have to have ongoing conversations about, and seeing the products and looking at real cases and talking to them about
And so it sounds like you have a relationship with these carriers, so
Mhm.
you're talking to them on a daily basis. So that kind of brings up another point here: relationships in the field. I mean, we're seeing in the marketplace a lot of places similar to us, our competition. They're going to sales desk type of things, and internal wholesalers type of thing, and you're still out and meeting with advisors, meeting with their customers. How important do you feel that relationship, those feet on the street, are for your people?
I think it's the most important thing. My mentor in my first job, his mantra was, you got to build a relationship to where you call them. And, at first you call them and, hi, this is Justin Sykes with Millennium Brokerage Group. Then it's Justin Sykes. Then it's Justin with Millennium. And then it's just Justin. And then by the time you got that relationship where you want it to be,
Yeah.
you're calling them and you're picking up the phone and saying, hey,
Yeah.
hey, Jason.
That's great.
You don't have to introduce yourself because they know who you are. Of course,
Right.
that was before cell phones, where your name was in the cell phone, right?
Right.
Now they know who you are when you pick up the cell phone. But
Right.
I think that's the biggest thing, because number one, people aren't going to trust you if they don't know you.
Right. Even texting nowadays, I feel like that's kind of replaced a phone call, which a phone call can do a whole lot more than just a text can. So
That's
you
right.
you might shoot an agent a text, be like, "Hey, saw your case, update here."
I agree. When people text me, I always pick up
Immediately
the phone
back.
and call them. And the reality of it is I've said this for years. Everyone wants to do everything with email because there's a trail of it, which is
Yeah.
really nice. But I mean, it takes you 2 days to get through something with
Right.
email. By the time
Yeah.
you go back and forth, when you can just pick up the phone,
You
and
lose
do
a
it in
lot of
10
that
minutes.
interaction.
Yeah. So it's a lot more efficient, a lot more effective, and I do think it differentiates people, because people, they're not doing that. And to your point with
Sure.
the sales desk mentality, people they might be making calls out, but they're making calls out for their own purposes, not for their partner's purposes.
You use the word trust. I mean, who can you trust? And certainly when you're out, you're working with people, you're sitting across the desk from them, you're able to develop that trust with them. But when you're dealing with people that are, a lot of times, they're just a year or two out of college,
Mm-hmm.
I question their experience.
Yeah.
I mean, it's easy to learn, a product or two products, but have you seen that product being used in real life scenarios? What's your thoughts on that?
I come from an insurance company, Nationwide, right?
Sure.
And Nationwide had a really good training program. I mean, you start off, and I think you were part of that,
absolutely. Yep, absolutely.
right? I mean, you
Yep.
start off on the sales desk and you learn, but
You learn, absolutely.
but you're learning what Nationwide wants you to learn,
Sure.
or what Lincoln or somebody, whoever the company
Yeah,
is, they
right.
want you to
Your
learn.
company, man.
Right.
That's oftentimes skewed from the reality of what's really going on out
Sure.
there.
Right.
Use indexed UL for an example. We've seen a lot of changes with the AG 49s and 49A and B, right? All these changes have gone through
Absolutely.
with the way products are able to be illustrated. If you don't really know what you're looking at, and you're looking at just what one illustrates the highest cash value, that's great. But does that really mean that's going to be the best one 20 and 30 years down the road? No, it absolutely does not.
Right.
If you've got a policy that has capped out for year after year after year on a high cap, that policy is going to do way better than the 6.5% that they're illustrating.
Right.
So you got to know what's really happening in the real world versus what the paper says and
Sure.
what your
Sure.
product development team is telling you this will do.
So, Justin, you've talked a lot about life insurance to this point. You also said you focus on a few other things. How is, we've seen it, interest rates are up a little bit from where they've been. And so what are some of the opportunities that you see in the marketplace?
We've had a lot of success with the people I work with in the annuity space. Interest rates are up. We saw low interest rates for a really long time. We had a long run of strong market performance, right?
Sure.
I mean, we had a bull market for 14, 15 years, up until maybe 2021, when things started getting real rocky and
Right.
kind of volatile. I think that actually helped our industry a good bit. You've seen a lot of people create a lot of wealth
Sure.
in just normal traditional investments, right? I think everyone felt like they were kind of on easy street, making money. It's making money every
It's easy.
year. It's easy. It's happening. It's safe.
Right.
As long as it's performing. It's safe till it's not.
Right.
So I think that in 2021, when the market became really volatile, I think that really helped people realize that there is a need for what we do in the protection space. So specifically with annuities, a lot of the business that we do is fixed index annuities, where you're eliminating your risk with a downside protection, floor of 0%, but you've got opportunity to grow when the market or specifically the indexes are performing well.
Sure.
So you're not just tying yourself up to a low fixed rate, which now aren't even so low anymore. I mean, you've got rates, in the fives
Sure.
that you can lock in for multiple years, which is
Right.
great. Also, we've seen carriers evolve their products where there's a lot of bonus opportunity, where they can get a lot of guarantees in their growth. So upfront guarantees or bonuses, and then as well as annual guarantees while the money is deferred and sitting in the annuity contract.
Sure. Yeah. Now, are you using annuities to create guaranteed income for people?
A lot of times we are. So, I mean, spend it now, spend it later, or spend it never. It's kind of the mentality that I learned at Nationwide. What's the purpose of the money that's going into the annuity? That kind of helps you direct where the money's going to go, or what type of product it's going to go into. Income is a big play.
Sure.
Pensions have gone away. A lot of people are worried about running out of money in retirement. So the idea of a lifetime income is something that really appeals to a lot of people. The other thing we look at is just for protected growth. So there's some fixed index products out there that have really good index strategies that you can allocate your money into. You still have that guaranteed protection, but then you've got in a favorable market environment or a favorable index environment, then you're seeing those, some really good returns on that.
Sure.
So for example, I really like the some of the triggered, the triggered index accounts.
Sure.
Which basically just means that, and depending on the carrier, if the index is positive year over year, then you're getting a stated rate, and those rates are strong. I mean, gosh, in the high, I saw one 10.75 the other day. So if the market is up or flat, then you're getting 10.75% credit to your account. Now, if you were invested in the market, could you get 20 when the market's up 20?
Sure.
So you're losing in that, you're giving up something, but you got 0% floor, so you're not going to lose anything.
It seems like you do a lot with helping people just protect their assets.
Mm-hmm.
What is one of the other big threats that people face when they're in retirement that can really get to a lot of their assets that they don't necessarily do a lot of?
Living too long. And specifically, I mean living too long and needing help, needing care. The average life expectancy is what, depending on where you look, 83, 84, 85.
Right. Yeah.
But my grandma's 95. And she walks really slow on a walker, but she is healthy.
Yeah.
She's on no medication. She's mentally sharp as a tack.
Wow.
The only problem that she really has is she can't hear. And at some point, if she lives long enough, she's going to need professional help.
Yeah.
So how do we pay for that? Because that stuff ain't cheap. The inflation cost for healthcare is going up significantly higher than just the average inflation, which
is out of control anyway.
It's been really high.
Right.
Yeah. I had a conversation with one of my advisors, and the advisor said they can certainly afford to self-insure.
Mm-hmm.
And I said, well, run the numbers. It was on a 10-pay basis. It would cost them about $140,000
all in
over the course of 10 years. These are people that can afford to self-insure. So if they can afford to self-insure, hypothetically $1 million or $500,000 of long-term care expense, if they need it, they can afford to spend $10,000 a year on an insurance premium. And we added an inflation rider on there. So by the time they were 80, they had like $2 million of protection.
Sure.
But at the end of the day, they're protecting $2 million of their assets that they would otherwise potentially have to pay. And it's cost them $140,000 to do it. That's leverage, man.
Right.
You mentioned they were in their late 40s. Can you talk a little bit on the importance of kind of shifting to looking at long-term care at a little bit of a younger age now versus in your mid to late 60s, like kind of traditionally over the last 20 years?
Yeah. Dave Ramsey came with the things, buy long-term care insurance at age 60. And he said, buy traditional long-term care insurance because it's the cheapest. Well, I would argue that it's not the cheapest, number one.
Not anymore.
It might be today. It might be the cheapest today,
right.
But you're going to pay for that forever, and your premiums are not guaranteed. The premiums are going to go up.
Sure.
Because people are living longer. Claims are going up. The insurance company can't pay a claim if it's not in business. So I think that that's completely wrong, number one. And I also think that there's still a chance. Yeah, there's a really good chance you're going to need care. I think the number is like 70% if you live to 65. We're all going to believe that we're in that 30%, right?
Right.
I'm not going to need it. You're
Naturally.
not going to need it. Neither are you.
Sure.
But one of us is. Actually, two of us are.
Right.
How do we protect ourselves from wasting money? Like an auto insurance policy. You're a good driver. You pay. Your premiums go up. No matter if you have an accident or not. You never have an accident. It was a complete waste of money, but you had to have it. Right?
Yep.
That's how I look at a traditional long-term care policy. You might not ever get anything out of that policy. I like these hybrid policies because you're guaranteed to get a death benefit out of it.
Sure.
If you don't need the benefit, somebody's getting something out of it. The money hadn't gone to waste. And that example that I gave earlier, they protected $2 million of assets, give or take, and the death benefit for $140,000 of premium. I think the death benefit was like maybe $225, $225, something like that.
So worst case scenario, they didn't lose it.
But back to your question, Matt, when's the right time to buy it? I think the right time to buy it is today. I think that's the case with anything insurance, really.
Sure.
It's only going to get more expensive the older you get. Maybe you can, maybe you can't qualify for it. If you wait till 60 or 65, but I mean, gosh, if you see the value and the benefit, it's a lot cheaper. It's going to be significantly less expensive to buy at 45 than it is at 65.
You know, how many calls have you taken in the last 2 years with people that just had some sort of event? Now they're uninsurable.
Oh, once a week.
Yeah, you talked about self-insure, and one thing that kind of stands out, you talked about some of your mentors in the past. You know, I remember a guy that used to say, you know, assets do not provide care, income provides for care. And so people, they got a lot of assets, but yet, you know, if you need care for an extended period of time, you've got to sell those assets, right?
Yep.
And that's the tricky part. You know, you may need to sell. It may be a great time in the marketplace, whether that's assets or in the stock market or real estate. It may not be a great time to make that transaction. Plus, you may be dealing with taxes as well. So you got this asset. It's got a lot of appreciation. You got to sell it. You may have to pay some taxes on it. And you got to sell at a time it's not so great because of market conditions, and you got to pay taxes. A lot of times those transactions don't work out as well as people think. You know, what, from your perspective, what are the benefits of these products that provide income?
And it's guaranteed day one, whenever you need it. I mean, you're not having to worry about, oh, if I invest this money in this, you know, real estate deal or whatever, you know, this stock or whatever it is.
Right.
In 10 years, I should have this. Well, that's great. What if you need it in 3 years? We look at long-term care as an end of life. And statistically, it is. People use long-term care at the end of their life. But, I mean, number one, some people don't live to be 80 years old. Number two, sometimes people need it before the end of life. My dad's cousin had Lou Gehrig's disease when he was like in his 30s. He got diagnosed with Lou Gehrig's, and he lived for 12 years.
Right.
Before he finally died and went downhill. And it was, you know, that he didn't have any insurance. I mean, of course, he was in his 30s when he got diagnosed. He didn't have the insurance that he needed. He left his family in a real mess. It's now's the time to be planning. Well, this kind of took a turn for the little dark turn.
Now I have to go do more planning. Yeah. I'm in the industry.
Exactly.
So you mentioned earlier, you work with a lot of property and casualty insurance agents. You work with a lot of investment folks. If you're a property casualty agency, you got a big book of business, and you've been thinking about getting into the life insurance business or maybe the fixed annuity business or the long-term care business. What would you say to those people that may be thinking about it right now? What would be the first step they would need to take in order to consider getting into this line of work?
The number one step is do it. Number two would be align yourself with somebody who can really help guide you. Somebody like a Millennium, shameless plug for us, but it's our podcast, right?
Right.
But I mean, we've got experience. You know, our team, we've got boots on the ground. We've got, I forget, we did the numbers, hundreds of years of experience between our team.
Right.
You know, and we understand the market, and we understand the property and casualty agency space, the struggles that they go through, and how to try to bypass some of this stuff and make it easier. And I had one agent that I met with him. I met him somewhere. We were introduced and we talked a little bit. This is a few years ago. Great guy. Had a really good agency, but he was a relatively young agency. And, you know, as you can imagine, he had a lot of things he was going on, a lot of things, a lot of hats he was wearing. He really wanted to get in the life insurance business, but it just wasn't on top of his list. A couple years went by, and all of a sudden the guy submitted a piece of business. I hadn't talked to the guy in 2 years, and he submitted a piece of business.
Yeah.
You know, he hadn't done contracting. He hadn't, you know, there were so many things that he needed to do on the front end that would have made the whole process easier.
Right.
But he basically started at step 4. I mean, really, if he had just called me and said, hey, Justin, I've got a case here that I'm ready to write. What do we need to do? We could have made his life a whole lot easier.
Right.
Because we know how to navigate the waters of getting started.
It's a little more than just submitting an application. Yeah.
He was like, hey, it's great. I did a drop ticket. This is the easiest thing I ever did. And I felt bad for the guy because I'm like, this is your first experience. And you're like, I don't want to do this anymore.
Right.
Traditionally at Millennium, we've talked a lot about, you know, leaving a legacy and generational wealth. What are you seeing in the business of leaving a legacy right now?
I think it's something that a lot of people want to do. I think it's something that we're seeing less and less of because people aren't planning properly. And because they're not planning properly, if it's high enough on their priority list to leave wealth to their heirs, a lot of times they're not living the life that they should be living now. If you look at the baby boomers, the generation before them, they saved and they saved and they saved. And I look at like my grandparents, they never made a lot of money, but they saved a lot of money.
Sure.
And as a result, they had wealth, not huge wealth, but they had some wealth. Then the baby boomers come along, and I feel like the baby boomers just spent. They started making more money and spending more money. And so as a result, they didn't have anything. So what my fear is, and what I think is true, is you're seeing a lot of that, not the ultra wealthy, but the people that made a good living, that accumulated some wealth.
Sure.
Once that gets passed on to that baby boomer generation, which would be like my parents, right?
Mm-hmm.
Your parents.
Right.
They would, those people, that's their retirement plan.
Mm-hmm.
So there's no wealth to be passed on to our generation. I think there's a lot of focus on buying things here and now, saving later. We talked about that earlier with the long-term care, right? I'll deal with it later.
Yeah.
And I think that's true. Personally, I didn't save as early as I wish I would have saved. I mean, looking back, I wish I would have started saving at 23.
Right.
When I got my first job and I didn't, I said, I'll just wait a little while.
Sure.
And it's been fine, but it could have been better. I think a lot of times people don't want to address the issues that they have. They don't want to talk about things because it's uncomfortable in the family situation. I think there needs to be open dialogue amongst families about what's my goal as a parent to do for you, or for you to do for yourself. And people just shy away from that stuff because it's not comfortable. I'll deal with it later. It's a lot easier to say.
I feel like the baby boomers would be okay. I mean, there was more solidified retirement plans. I mean, you had 401ks, pensions were around. I mean, they were abundant. Now pensions are all but gone. I mean, you still got your traditional 401ks and such, but I feel like in potential future generations, there might not be any set plans. It might just be on you to plan it out yourself with a financial advisor. How do you see that playing out in the future?
I think now there's a need. We have to, because we don't have an option. The average person doesn't have that to fall back on. So you have to do a good job of planning, because Social Security is not going to do it.
Right.
No.
If you don't have a pension, how are you going to retire? Are you going to work till you're 80, 90?
I mean, I've actually heard people say that. They're like, I'm just going to work till I drop over. That's not always an option, though. I don't think
and
people
that might be good
that.
if it works, but I mean, for some jobs, but not for others. And I can't tell you how many times I sit across the table from somebody and they're getting near to retirement and they think they're doing all right, and they don't have enough.
Right.
I mean, they don't have nearly enough. And it's not like you can cut some things here and there. It's like you're going to run out of money in 2 or 3 years.
Sure.
On the flip side, there's some people out there that I was working with. I work with somebody right now that worked for 30 years for Terminex or Orkin or something.
Sure.
And she accumulated significant wealth in her 401k.
Sure.
And she's set. It's great.
On the flip side, what would you recommend in that scenario when you've accumulated significant wealth and now you're in a stage where you're like, okay, I just want to live my life? I mean, there's opportunities there as well.
One of the things I've heard this guy say a lot is a lot of times people plan to save, or they have a plan for their savings, but they don't have a plan for how they're going to get it out of there. And a lot of times when they're working with a financial advisor to help them accumulate the assets, that's all the financial advisor does, is trying to help them grow and grow and grow.
Right.
There's no plan for distribution. I think life insurance can be a really good asset for an income distribution solution. People look at this as a pure protection vehicle. They don't look at life insurance as something that can actually work for them while they're alive.
Yeah, I mean, if you've accumulated enough, I mean, you can then purchase a life insurance policy and then kind of freely spend what you want and have fun on the way out. I mean, that's another thought process.
How many times do you hear an older person saying, well, I don't want to spend that because I want to leave my money to my kids?
Right. Is there a better way to do it?
Yeah, if you're not getting the things that you need because you're wanting to leave money to your kids, well, you're cheating yourself.
Right.
So
spend
Tom
your money.
Hegna, buy life insurance and spend all your money.
Spend your money, leave your kids life insurance.
Something they don't have to worry about. They can get it in a few weeks and go on their way.
Right.
Do whatever they want with
Life insurance is tax-free.
Yep.
Avoids the probate process.
Yep.
And it's payable immediately. So do a lot of your property and casualty insurance also insure businesses?
Yeah, the ones I work with do.
What are some of the opportunity that you see in the marketplace working with some of those business owners?
Number one, I think that business owners have assets a lot of times. And a lot of times their asset is their business, but a lot of times they have other assets as well. So there's a planning opportunity. There's a protection opportunity. In the business itself, I think there's a lot of opportunity specifically with life insurance. If there's a partnership, we've seen this Connolly case, the U.S. Connolly versus the U.S.
Sure.
Where a family didn't have proper business buy-sell planning, and it ultimately ended up costing the surviving family almost $1 million, $900,000,
almost $1 million in extra estate taxes.
Yeah, an extra estate taxes because their business wasn't valued properly.
Right.
I think that one of the main issues we see with partnerships is that a partnership gets set up, they start a business, they go into it with the right intentions of protecting themselves with a buy-sell agreement, maybe funding with life insurance or disability insurance, and then that's it.
Right.
And then, 5, 10, 20, 30 or 40 years go by. Oh yeah, we're covered. We got a buy-sell agreement. Well, that's great. But your business is worth a whole lot. And I think we're in such a fast-paced environment, especially as a business owner.
Yeah.
that they've got so much going on that they just forget about stuff.
Sure.
You know, it's not on top of mind.
Yeah.
And in the case of Conley's, you know, it takes somebody dying and having to pay a bunch of money that you weren't expecting to pay before it becomes, now we realize we have a problem.
Right.
How do we fix this?
Sure.
You know, it's like the guy that had the heart attack that's trying to get life insurance tomorrow. I also think that from an advisor or an insurance agent's perspective, that also helps protect their business. Because if the business, who's the client, the business owner, if that business can sustain, then you haven't lost a client. But, you know, my very first job when I was in college, I worked for a medical billing office. And it was my best friend's dad. He was the owner. He got lung cancer and he died.
Yeah.
Well, about, I don't know, maybe a month before he died, because of he was the main backbone of the company.
Right.
Their biggest client left.
Yeah.
And the business, they started doing layoffs. And then another client left. And it all fell apart because of the death of that owner.
Sure.
So how do you protect the business from falling apart at the death of an owner or a key employee or both? Most of my agents have lost clients because of a death or, you know, transitioning to the next generation.
And so there's probably just some basic things that we can do inside of our agencies to help some of those people, and starts with just a review of some of the stuff they've already done, right?
Yep.
To your point, you know, a lot of times they put together these plans, they go into a file cabinet, they don't get reviewed for a period of time. So it could start by just taking a look at what they already have.
Yep. Well, the buy-sell agreement needs to be reviewed, number one, to make sure that it still meets your needs. Are the same business partners the business partners?
Yeah.
I mean, that's
right.
Things, people come and go.
Right.
Right. And a lot of times people forget to overlook this stuff.
And in the case of like Conley, right, they didn't have a business valuation.
Yeah.
Nor did they have a formula to establish what the business was worth.
So then they left it to the IRS to establish what it was worth.
Right. That's not a good
That's a bad strategy.
Yeah. That's not a good strategy.
That's never worked out for anybody.
Right.
I think.
Yeah.
A simple review. You know, it's kind of like the beneficiary reviews we always used to talk about.
Right.
It's just a way to get a conversation going and
Sure.
And get in front of those business owners, because those are the ones that are putting real revenue on the books.
Right.
You know, you got 4,000 homes that you're insuring or automobiles that you're insuring. You lose one of those, not the biggest deal in the world typically, unless it's me, because auto insurance premiums
so
are
much
through the roof. You know, they'll feel that one. But you know, you lose a commercial account that's generating, you know, $100,000 of revenue.
Right.
That's going to hurt.
Right. You're working with agents on a daily basis, agents, advisors, and stuff. Just, you know, how many people are you working with?
I've probably got maybe 60 agencies that are working with us.
How many are actively
actively working? Maybe 20, 25.
Sure.
And then that I'm working with closely on a regular basis, 8 to 10.
You know, of those 8 to 10, what are you seeing that kind of differentiates them and makes them stand out? And why are you intimately involved working with them?
The biggest thing is that what I do, financial services, is important to them. Number one, it's not something they have to do. It's something that they want to do. So they enjoy doing it. And as a result, they're being rewarded for their work. Because it's important to them, it's a focus that they have. They're not just doing it, you know, because they have to, or they're not doing it because this guy asked for, you know, hey, do y'all sell whole life insurance or whatever, right? For my grandkids.
Right.
They're going out there and they're being proactive. They're trying to find customers, or they're going in their customer base to try to find opportunities to review buy sells.
Sure.
To write annuities, talk to people who are retiring or nearing retirement, and try to offer them solutions in the annuity space or long-term care space. But they're specifically focused on something. The top 2 partners that I have that really, really get it done for themselves, for their agencies, they're kind of focused on 1 or 2 things. My largest producer for a long time, you know, he wrote about $500,000 of premium in 18 months, and he only wrote about 40 policies.
Yeah.
So he was looking at larger policies, estate planning. And the cool thing about him was he wasn't afraid of it. He wasn't afraid of the premium. You know, a lot of times, I mean, I've had a lot of conversations with people where they need a $2 million second to die policy, for example, and the premium is $50,000 a year. And the first thing out of the advisor's mouth is, oh, they'll never pay that.
Yeah.
Yeah. Well,
So they've already talked themselves out of a sale. They're not going to go
Yeah.
talk. They can't sell to their client. But this guy in particular, he wasn't afraid of that.
Right.
You know, I never forget. I actually said it once. We ran this premium on
I
an
remember.
older woman, and it was like $130,000.
The first
And I was
words
like,
out of your mouth
dude,
were,
she's not
she'll
gonna buy
never
that.
pay it.
yeah.
And he goes, let's give it a try.
Yeah.
And I'm
And
like,
she bought
and
it.
I'll be dog. She bought it. So I'm like, hey, you know,
Right.
that's the key. Is he's like, this is what he wants to do. He wants to work in larger policies, and they weren't all, I mean, he wrote 2 really big policies like that,
Right.
but he wrote a lot of policies that were, 20, 30 grand.
Right.
And, those make a big difference. I would say my best producer is really focused on annuities right now. And he understands it backwards and forwards. He focuses on a couple different product solutions for a certain type of client.
Yeah.
And he goes to him and says, hey, this is what I'm doing. Do you think that'd benefit you? And they see the value in it, and they trust him.
When you talk about that, the word that comes to my mind is an intentional business.
Yep.
They're very intentional about who they're talking to.
That's right.
What they're looking for. And I think you've talked about this in this podcast here. That changes over a period of time, right? Because of the market environment, because of volatility, because of certain things. So I think one of the things that I look at somebody in your position that I think you bring a lot of value to the people you work with, because you can help them develop that intentional business.
Mm-hmm.
You're able to see not only what it is you're doing, but you've got 8 other colleagues that are doing the same thing. And we talk, weekly? We're talking all the time. And you get to see what other agents are doing in other parts of the country. And so we're able to bring the best practices to the table, and say, hey, look, if you were to be intentional about this, here are the opportunities that exist in this type of planning.
Yep. I think that really resonates with the clients too, though.
Sure.
You're going there with confidence about what you do.
Right.
Not just, what do you need? I can do it for you. I can get it done for you.
Right.
That's kind of the old joke, right? You're in the insurance business. What kind of insurance do you sell? What do you need?
Yeah.
I'll tell you what you need. But really, you're going to find your more successful people when they're focused on a couple things and they're intentional about what they're doing.
The other piece of it is that your customers understand leverage.
Yep.
Because at the end of the day, you're bringing leverage to them. Right. So if they can be intentional with a piece of their time, that just kind of leverages the amount of money, the amount of things, the amount of help they can provide other people. If you're an insurance agent, you're a PNC agent, and you want to kind of get into this business, right? You're able to help a lot of people out. What's the first step? What should they do? Give you a call?
Yeah, give me a call. Because everyone's different. I mean, there's no give me a call, give us a call. We've got the good news is we've got people that are in different parts of the country, so it's not like you've got to work. If you live in Washington, although one of my best partners does live in Washington State.
Sure.
And I live in North Carolina. You don't have to do that gap. We've got people around that can be more localized,
right,
to meet your needs. But give us a call and let's talk. One of the things that I always try to tell people up front is we might not be the best fit for you. You might not be the best fit for us.
Right.
It really depends on, I don't want to sit there and say I can do whatever you need me to do, because I can't. I mean, I'm a human.
That's unrealistic.
Yeah. Let's figure out what you're trying to accomplish, and if I can help you with that, that
starts
great.
with a conversation.
Yeah, let's
right?
just have a conversation
Right.
and figure out where we align.